In the first half of 2026, the story of global markets is once again being written by interest rates. From Australia to parts of Asia, central banks are trying to answer the same question. How do you slow inflation without breaking growth? For households, that question is not abstract. It means higher mortgage repayments, tighter household budgets, weaker consumer spending, and more pressure on already fragile business confidence. In this video, we will look at the current rate hike, backdrop in Asia and Australia, why central banks are moving in different directions, and what this means for everyday people, property markets, currencies, and regional growth. The big picture is simple: inflation is proving sticky in some economies, while growth remains too weak in others to justify aggressive tightening. To understand the current cycle, we need to start with inflation. In Australia, the Reserve Bank said, inflation picked up materially in the second half of 2025, with greater capacity pressures and rising fuel and commodity prices, adding to inflation in 2026. That is why the RBA lifted the cash rate to 3.85% in February, to 4.10% in March, and then to 4.35% in May. The RBA also said inflation is likely to remain above target for some time, and that risks are tilted to the upside, including inflation expectations. This matters because central banks do not raise rates simply to punish borrowers. They do it because persistent inflation can become embedded in wages, prices, and expectations, making it harder to bring under control later. Australia is now one of the clearest examples of a central bank turning more hawkish again in 2026. The RBA first moved in February, then followed up in March, and again in May, taking the cash rate to 4.35%. The RBA's May statement said higher fuel prices were already adding to inflation, and that some firms facing cost pressure were looking to raise prices of goods and services. It also warned that a longer or more severe Middle East conflict could lift global energy prices further and weaken growth in Australia and its major trading partners. In practical terms, this is a classic stagflation risk. Inflation stays high while growth becomes weaker. That is the kind of environment where central banks have very little room to maneuver. The fastest channel from higher rates to the real economy is the household balance sheet. In Australia, household spending has already shown signs of strain, with spending falling in December and only a modest rebound in January, as consumers stayed cautious in the face of rate hike expectations. That weakness is easy to explain. When mortgage repayments rise, families often cut discretionary spending: first restaurants, travel, entertainment, and non-essential retail. The RBA has noted that credit is still readily available, but the real issue is affordability. Even when credit is available, many households simply cannot absorb another layer of repayment pressure without reducing consumption elsewhere. Housing is usually the most visible casualty of a rate hike cycle in Australia. Higher rates reduce borrowing capacity, slow auction demand, and put downward pressure on price growth, especially in cities where mortgage debt is already high. Recent reports suggest home price growth has slowed, and household sentiment has weakened as borrowing costs rose again. That does not necessarily mean a crash, but it does mean less momentum in the property market, and more pressure on first home buyers trying to enter at current prices. For existing homeowners, the effect is immediate. Repayments rise faster than wages for many borrowers. For investors, higher yields can help, but only if rental income and vacancy conditions keep up with financing costs. Asia is not moving as one block. Some economies are still facing inflation pressure and are leaning towards tighter policy, while others are holding steady because growth remains fragile. Japan is a good example of a cautious tightening path. The Bank of Japan kept its policy rate around 0.75% in March 2026, but said it will continue to raise rates if the outlook for economic activity and prices is realized. The BOJ also noted that wage and price setting behavior is gradually supporting a virtuous cycle. While recent rises in crude oil prices are creating additional upside pressure on inflation, so even in Japan, where policy is still far looser than in Australia, the direction of travel is no longer purely accommodative. South Korea shows another version of the same regional tension. The Bank of Korea kept rates steady at 2.5% in February, but inflation and growth forecasts were revised upward, leaving less justification for an easing stance. By early May, South Korean consumer prices were rising 2.6% year-on-year, near a two-year high, which increase the likelihood of rate hikes. That is important because Korea sits in a highly open, trade-sensitive economy where global energy prices, the dollar, and export demand all matter. The regional spillover is straightforward. When several Asian economies face tighter conditions at once, capital flows, exchange rates, and borrowing costs can move quickly, affecting everything from manufacturing margins to consumer confidence. Asia is especially exposed to higher energy prices and global supply shocks. A rise in oil and fuel costs feeds quickly into transport, food, and industrial input prices, which then broadens inflation across the region. That is why central banks have become so sensitive to inflation expectations. Once households and firms start assuming prices will keep rising, wages and pricing behavior adjust, and inflation becomes harder to reverse. At the same time, many Asian economies are still dependent on exports. That means tighter monetary policy at home can collide with softer global demand abroad, leaving governments and central banks stuck between inflation, control, and growth support. Interest rate differentials matter for currencies. When Australia tightens faster than peers, the Australian dollar can strengthen, while bond yields rise, and capital flows may shift towards higher-yielding assets. A stronger currency helps imported inflation, but it can also hurt exporters and resource companies by making their products more expensive abroad. So even one good move for inflation can create a new problem for trade competitiveness. Bond markets also react quickly. Higher rates usually mean higher yields, and that raises financing costs across the economy, from government borrowing to corporate debt and mortgages. For households, the main message is defensive. Expect higher mortgage stress, more cautious spending, and slower recovery in discretionary consumption if rates stay elevated. For investors, the landscape is more selective. Banks and defensive sectors may hold up better than highly leveraged consumer and property-linked names, while currency exposure becomes more important than usual. For businesses, the key issue is pricing power. Companies that can pass on costs may survive the cycle better, while businesses with thin margins and weak demand may struggle as borrowing costs and wage pressures stay high. The real story in 2026 is not just that rates are high. It is that central banks in Australia and parts of Asia are still dealing with inflation that has not fully behaved, while growth is no longer strong enough to absorb much more tightening without pain. Australia is already feeling the pressure through household spending, mortgages, and housing. Across Asia, the effect will be uneven, but the common theme is the same. The era of easy money is still not back.